If you're looking to buy Polestar stock, then keep watching this video because we're going to look at the company's recent news, how the market's treating the company, and what are the technicals telling us, and most importantly, what is the best trading approach. As the market is very volatile for the moment, we should be mindful of which positions to pick as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Polestar has recently completed the merger with a SPAC and is now floating freely on the market based on investors' expectations. After the recent week's volatilities, I would say that so far, Polestar has maintained its ground compared to before the merger. For some companies, their price action after the merger tends to be very volatile and usually downward pointing. This might have been caused by the changes to the greater environment, as capital initially flowed into the tech sector back in 2020, and this sent some share prices up and sometimes skyrocketing. The best examples of that phenomenon would have been CCIV and Hyliion back in 2020. But now that we're in 2022, I believe that the new tendency is to have additional skepticism about the company's capacity to prosper or to at least provide value to shareholders. Rivian is a good example of that phenomenon. Having gone public as one of the highest market caps to ever go IPO with, its value has dwindled significantly ever since. That's why I believe that Polestar is more stable, balanced, and has more potentials for the future. If we think about it, the company has been able to live through the current period without losing significant portions of its capital, or the market cap, and that is quite a feat by itself, arguably something that hints for a better future. Now, let's take a look at the technicals of the stock. The trading volume of Polestar has recently been around 1.9 million shares versus an average volume of 5.7 million shares. Over the previous 52-week period, the price fluctuated between $8.53 and $16.41. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price, but the low liquidity could also mean that the demand is limited as well. When we compare the current price against the average volume, there might be possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, current volume would be significantly higher than the average volume. The market cap of Polestar is currently around $4.8 billion versus an enterprise value of $1.1 billion. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's own reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies are the intangibles, meaning they're not items that we can see, touch, or use, but pledges for a better future, such as intellectual properties, brandings, and its reputation. For startups, most of their valuations are based on the intangibles, and if they were valued in more favorable market conditions, this could mean that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's only trading below the book value, and that doesn't mean the company itself is necessarily undervalued. It's also possible that a company was overvalued in the first place and only deflating to where it's supposed to be. As we compare the current price to the historical price fluctuations, the stock is 15% higher than the 1-month low, 17% higher than the 12-week low, and 17% higher than the 52-week low. On the option market, which gives a hint about the market sentiment of where the stock price could go next, the implied volatility is 90% versus a historical volatility of 100%. The put-call volume ratio is currently around 0.39. It is normal for most stocks to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 4.6 thousand contracts a day versus the 30-day average of 21,000. In terms of open interest, the most recent volume of open interest has been 150,000 contracts versus the 30-day average of 213,000. The option contracts are tools allowing traders to hedge their risks, increasing their exposure with limited downside or a revenue stream. They are derivative contracts based on the underlying security. They give traders the possibility to buy or sell the security at a predetermined strike price and help limiting the potential downside. The put options allow selling at the strike price, usually for anticipated downturn, and the call options allow buying at the strike price, usually for the anticipated bullish run. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price were to fall lower. Sometimes there are significant short interest in the stock, and that could have an influence on our outlook. So if there are significant short interest, usually above 25 to 30%, there could be a potential for the short squeeze, whereby traders buy the stock up, force those short positions to redeem themselves, and to act as an additional buy on the already higher stock price. And this is what people often refer to as a short squeeze, and it became a popular concept in recent times, with stocks like GameStop and AMC been successfully short squeezed. The short interest is currently about 20% of the total float, and 43% of them are coming out outside of the public exchanges. I would recommend to slowly buy into Polestar over the next 12 months and to hold it for at least that long for the long-term growth potentials. I would therefore recommend to commit between 3 to 5% of your portfolio, and would also recommend to split the allocation in batches of 20 or even 10% at a time to write off the short-term volatilities. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth-type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.